Hello everyone, and welcome back to Iraqi Dinar Intelligence. Today we have a very important and major update regarding the US dollar, the ongoing tensions between the United States and Iran, the pressure on global currencies, rising oil prices, and what all of this could mean for Iraq, the Iraqi dinar, and the global financial markets. This is not just another currency update. The developments we are seeing right now are affecting oil markets, international trade, inflation, and investor confidence across the world. So make sure you watch this video until the end because today's information is extremely important for investors, traders, and anyone following the Iraqi dinar and global currency markets. The US dollar remained close to a sixth-week high on Friday as financial markets reacted to mixed signals coming from the ongoing discussions between Washington and Tehran. Investors around the world are trying to understand whether the situation between the United States and Iran is improving or moving toward another dangerous phase. While some officials are talking about positive signs in negotiations, others continue to hold firm positions, creating uncertainty in global markets. According to reports, U.S. Secretary of State Marco Rubio mentioned that there had been some good signs in talks with Iran. That statement briefly created hope among investors that tensions in the Middle East could eventually ease. However, Iranian officials maintained their strong stance regarding uranium stockpiles and control over the Strait of Hormuz, showing that major disagreements still remain unresolved. Now, for those who may not fully understand why this issue is so important. The Strait of Hormuz is one of the world's most critical oil shipping routes. A huge percentage of global oil exports passes through this narrow waterway every single day. Whenever tensions rise in this region, investors become nervous because any disruption in oil supply can push energy prices sharply higher. This is exactly why global markets react so strongly to every statement coming from either Washington or Tehran. As uncertainty increased, investors once again turned toward the US dollar as a safe haven currency. The dollar index climbed near 99.23, remaining close to the recent peak of 99.515, which was the highest level since April 7. Although currency movements in Asian trading remained relatively calm compared to the volatility seen overnight, investors are still waiting for more clarity before making larger decisions. At the same time, European currencies remained under pressure. The euro fell slightly to around $1.1607 and moved toward its second consecutive weekly loss. The British pound also weakened slightly despite economic data showing major weakness in retail sales. Reports indicated that retail sales in the United Kingdom dropped by the most in nearly a year during April, highlighting the growing pressure consumers are facing due to inflation and high energy costs connected to the Iran conflict and global instability. The strength of the US dollar is not only connected to geopolitical tensions. Another major reason behind the dollar's rise is the resilience of the American economy. Recent U.S. economic data showed that weekly jobless claims declined while manufacturing activity rose to its highest level in 4 years during May. These numbers indicate that the world's largest economy continues to show strength despite global uncertainty. This combination of strong economic performance and geopolitical fear creates ideal conditions for the dollar to remain strong. Investors often move their money toward safer and stronger assets during uncertain times. And historically, the US dollar has remained the preferred choice during global crises. Market analyst Tony Sycamore also commented on the situation, saying that despite several weeks of ceasefire discussions, there is still no convincing evidence that the United States and Iran are close to a complete resolution. According to him, risks for the US dollar still point higher because there does not appear to be an easy solution to the Middle East conflict. He suggested that if tensions continue, the United States may eventually need to become more forceful, which could increase uncertainty even further in financial markets. Now let's talk about one of the currencies suffering the most from this situation, the Japanese yen. The yen continued to weaken and struggled near the 159 level against the US dollar. This is one of the weakest positions the yen has reached in decades. What makes this situation even more interesting is that Japanese authorities likely intervened in currency markets only weeks ago to support the yen. However, despite those efforts, the currency has already lost nearly 75% of the gains it achieved after the intervention. This has placed traders on high alert because markets are now watching closely to see whether Japanese officials will step into the market again. However, many experts believe intervention alone cannot solve the problem. Currency strategist Lee Hardman explained that what Japan really needs is a change in market fundamentals. In his view, one of the best possible outcomes would be a quick agreement that ends tensions with Iran and stabilizes oil prices. Japan faces a very difficult economic challenge because the country relies heavily on imported energy and goods. When oil prices rise and the yen weakens, imports become much more expensive. This increases inflationary pressure on businesses and consumers across Japan. Recent data released on Friday showed that Japan's core inflation slowed to a 4-year low in April. This creates another major problem for the Bank of Japan because it complicates future monetary policy decisions. While other major central banks around the world continue raising interest rates aggressively, Japan has been moving much more slowly. This difference in interest rate policy puts the yen at a disadvantage. Investors naturally prefer currencies linked to higher interest rates because they can earn better returns. As a result, many investors continue selling the yen and moving their money into stronger currencies like the U.S. dollar. On a trade-weighted basis, the Japanese yen is now sitting near record lows, while a weaker yen can benefit Japanese exporters by making their products cheaper internationally. It also increases the cost of imports and energy supplies, creating pressure on households and businesses. But Japan is not the only country facing problems. Emerging Asian currencies are also experiencing enormous pressure because of rising global oil prices and the strength of the U.S. dollar. Policymakers across Asia are now taking urgent measures to protect their economies and currencies from further declines. Indonesia recently announced a major new policy requiring all exporters of natural resources to keep 100% of their export revenues inside state banks starting from June 1st. This unusual move was introduced to support the Indonesian rupee, which has been falling sharply under global market pressure. These actions clearly show how serious the current situation has become. Governments across Asia are now actively trying to stabilize their financial systems before conditions worsen further. Now the big question for Iraqi Dinar followers is this: what does all of this mean for Iraq and the Iraqi Dinar? As we all know, Iraq's economy is heavily dependent on oil revenues. When global oil prices rise, Iraq can benefit from increased income, which may strengthen government finances. However, there is another side to the story. A continuously stronger U.S. dollar can create pressure inside Iraq's local markets. The Iraqi market has already been dealing with ongoing concerns regarding dollar exchange rates. If the U.S. dollar continues strengthening globally, it may increase pressure on local exchange markets inside Iraq as well. Imported goods could become more expensive, and businesses may face additional financial challenges. At the same time, Iraqi investors and currency traders are paying very close attention to every development between Iran and the United States. Iraq sits in a very sensitive geopolitical position and is directly affected by changes in regional stability. If future negotiations between Washington and Tehran eventually produce a major agreement, global markets could calm down quickly. Oil prices may fall, the U.S. dollar could lose some strength, and Asian currencies might begin recovering. However, if negotiations fail or tensions rise again, markets could experience another wave of volatility and uncertainty. Many financial experts are currently advising investors to remain cautious. Currency markets have become highly unpredictable, and sudden movements can happen at any moment depending on political developments and economic data releases. It is also important to remember that the global economy is already struggling with inflation, supply chain disruptions, and geopolitical conflicts. Any additional escalation in the Middle East could increase fuel prices, food costs, and transportation expenses around the world. One thing that has become very clear throughout this crisis is that the U.S. dollar still remains the world's dominant safe haven currency. Whenever global uncertainty increases, investors continue moving toward the dollar for protection and stability. That is exactly why the dollar has continued receiving strong support during this entire situation. Now the world is waiting to see what happens next. Will the United States and Iran finally reach a meaningful agreement? Will oil prices stabilize? Will the Japanese yen continue falling? And most importantly for our viewers, how will all of this affect the future of the Iraqi dinar? These are the key questions that will shape financial markets in the coming weeks and months.